Hello, how are you? Mehran's here, your trading companion, and we are going to talk about accumulation, manipulation, and distribution in sessions. We talked about the characteristics of every session in the trading hour videos, and we talked about accumulation, manipulation, distribution, and what that means in ultimate liquidity video number 1 and ultimate liquidity number 2. This video is the liquidity video number 3, and we want to talk about accumulation as Asian session, manipulation as London session, and distribution as New York session, so you can use that in your day trading. So what is accumulation, manipulation, and distribution? We talked about this concept in those two liquidity videos and in trading hours videos, but I'm going to show you the schematic and the pattern again, and after that we are going to talk about sessions and how those sessions are going to behave in a way that remind us this pattern. This pattern is AMD, or accumulation, manipulation, and distribution pattern, and it's based on the schematics of Wyckoff. It's the simpler view toward Wyckoff, and believe me, the simpler view toward Wyckoff theories is better because he just observed the market and he showed us some patterns that markets are going to behave in that way most of the time. But because that's just theory and that's just some schematics, you should make some strategies based on them. For example, when we are going to talk about shifts, and we talked about this in the prior videos, you can see that we say that it is a shift and it comes back and it goes down. It is the simpler kind of AMD pattern and Wyckoff schematics. So when we make Wyckoff schematics simpler, that is going to be better and help us more because it's more practical. Anyway, here we have three phases of accumulation, manipulation, and distribution in this schematic. So this part is going to be the accumulation phase, the phase that accumulates order for the market to move. This phase is the manipulation phase. It manipulates the stop loss of sellers or the buyers. That doesn't change the way that market moves. And here is the distribution phase. It's going to be red. It's better to be red. Anyway, what does it mean? Does it mean the big players, the market makers, or those people who have the money and have the power to move the markets are going to look for our stop losses? No, I don't believe in that, and you'd better to not believe in that because it is going to draw your attention to some fake gurus and some fake methods, and you don't want to do that. Anyway, but the more important thing is that the market draws itself to liquidity. Why? Because it needs fuel to move, and those big players need big chunks of opposite orders to fill their orders in the way up or in the way down, and to close their orders in profits or in small losses. What did I mean exactly? For example, you want to buy 100 kilograms of corn. There should be somebody who is willing to sell to you that amount of corn. Is that right? And the markets are the same. And the charts only shows us that in a graphical way. So, for example, a big institution or 100 of them knows that the number 107 to 107.5. These are good numbers to sell the US dollar index. And they want to sell from, for example, let's go lower, from the number 106 to 108, for example. They want to sell the market in that range. They know that the market is in premium price for this season, for this year, and they know that the market will go lower than those numbers. So they are willing to sell the market in those numbers. So they say that we are willing to sell the market from this point to something above that number. But their orders is not one lot, is not 10 lots. It's, for example, 1 million lots, for example. So they need a lot of opposite orders so they can sell to this market. And they need some people to buy their selling orders. So what they do? They don't know where the market is going to start to go down from, and they don't know exactly where those orders are. But all of us, it doesn't change in the way that you are trading. All of traders are going to put their stop losses in the same lows and highs. The one fact is that for them. So, for example, this high and or these highs, it is a good place to be a pool of liquidity for them. And the Asian session in itself, I'm going to talk about that. The Asian session itself, because it's the session before the London session, before the New York day starts. It's the session that the institutions are accumulating their orders on paper or on the markets. So they start to sell the market from here, and they know that most of the traders are going to put their stop losses on the exact highs and the exact lows, or put their trailing stop. They don't care if you sold the market way up here and you are in profit. They just want to fill their orders, and a big amount of the orders are going to fill in these kinds of places where our buy stop and sell stops are. They don't want to hit our stop losses. They want to fill their orders, and they want somebody to buy their sell orders. What happens here when it breaks this high? The market breaks this high. First, some of the traders sold here, and here, and they put their buy stops or stop losses here. Because when you are selling something and you want to close your position, you are going to buy that position back. So you sold here and you put your stop loss here. So it's, for example, one lot of buy stops. And the classical trader whose strategies are based on some shapes that are being used in kindergartens to amuse 3-year-old children, for example, put that triangle in its hole, put that cycle in its hole, they are going to find here as a breakout setup. They say that, oh, the high of the Asian session is broken, or the high of this very complex movement of the market, this very complex schematic and pattern that is just a ranging market. They said that it is a breakout, so let's buy here. So those buys is the second part of this formula. And what is happening here? They are buying from these big institutions who are selling to them. So the basic of accumulation and manipulation is that the big institutions have big chunks of money and they can just go and fill their orders in 1 second. They need to plan where and when they want to fill those orders. And in big markets, the opening hours or the sessions before that market are the sessions that they are filling their orders on paper or on big institutions like CLS and other liquidity providers. So they are filling their orders before the London market, before the New York market. So it is really the accumulation phase of the market. Anyway, so this part is the Asian session. And in the London, the market comes up, grab the high or low of the Asian session, and it reverses and it shifts. So it is the London session. And in the New York session, the market sometimes just go and distribute, and sometimes it come back, it grabs some kind of liquidity, for example here from the London session or from the opening hour of the New York, and then it starts to going lower and distribute their positions. And in the way down, you can see some kinds of liquidity points that are being used for closing these positions in profits. And you can see how the market reacts to these liquidities. It bounces a little bit and then it starts to go lower. I said that it's not 100% accurate. So when we have a trending Asian session, the market doesn't go back and, for example, liquidate the low or high of the Asian session. It is going to continue that movement. But how? For example, it is our Asian session here, and it is trending. It comes down, it grabs some liquidity, and it starts to go higher. But it doesn't go back and grab, for example, this low. It just comes back, it grabs some kinds of liquidity, it hit a point of interest or POI and goes higher. And sometimes when the London session couldn't take out the high of the Asian session or the low of the Asian session, or the London session is ranging itself, the New York session acts as manipulation session. So for example, if the Asian session is ranging or it is trending and the London session is ranging, then for example, New York session comes and grabs that high and goes lower. Another important thing is that the opening hours and Frankfurt session acts as liquidity as well, but we don't care about them because they are just some limited window of time. The most important thing after this concept, after you learn this concept, is that when you want to trade the accumulation, when you want to trade the manipulation phase or the distribution phase, you should pay attention to two things. First is going to be that it should grab the liquidity. Three things actually. First is going to be that it should grab some liquidity. For example, it grabbed these liquidities in a London session in the manipulation phase, and it grabbed these liquidities in the distribution phase when you want to trade them. The other thing is that it should hit some kinds of POI that can be a FVG or fair value gap, that can be an order block, or that can be a support and resistance, any kind of POI that you are interested in. So it should hit a POI after grab of the liquidity. After that, it should shift in the lower time frames. For example, if we are seeing this chart in 15 minutes, it should shift in 1 minute 15. So, or here it should shift in 1 minute. So we have three important things to pay attention to. First, it should grab some liquidity. Second, it should hit a POI, and after that it should shift in the lower time frame. And something is essential. I mean, if that doesn't exist, we don't trade, and that is going to be trend of the market. So for example, if it is going up, the market is going up, this is not a valid setup. We should pay attention to the low of Asian session, except when it goes up, for example, hit a 4-hour or daily POI. When it happens, we can say that so the market may reverse in lower time frames, but we should always follow the trend and trade in the direction of the market, except when it hits a higher time frame POI. Let's see these concepts in action on charts. We talked about sessions and how we can trade after liquidation of Asian session. We talked about liquidity in previous videos, and I wanted to talk about something here. If you think you can learn how to trade, learn how to invest, and learn how to steal the money of a trader who is 15 years or 20 years in the markets, you can do that with I don't know, 5 minutes or 10 minutes strategies on YouTube. So I know that videos are so long, I know that videos maybe is a little boring, but it is the basics of how the market moves and what and how the market reacts. So we need to build that base and build that foundation of knowledge in your brains carefully, so you can be a good trader. Anyway, so what I said so far, I said that we needed a liquidation of Asian session in the London session and a continuation plus liquidation in the New York session to take trades after the shift happens. So we need a POI. For example, if we want to trade here, we need a POI here, and it didn't come and liquidate this session, and that is because it liquidated the New York session. We don't care about this, we just want to follow the rules I talked about here for today. For example, today in the live market, we can see that the market came up, it liquidated the high of the Asian session, and it hit this POI, which is a long shadow. Long shadows have imbalance and order blocks inherently. So when you see a long shadow, I am going to talk about which order blocks are valid, but anyway, when you see a long shadow, you can say that this long shadow may be an order block plus it has imbalance in this shadow. Anyway, it is a good POI. We can see that the Asian session was trending, but it has some liquidities here. The Frankfurt came and grabbed this liquidity, and in the lower time frames we want to see shifts. What is a shift? A shift is when we have a kind of AMD pattern, so we can enter, for example, on some order block or imbalance here. After it comes down and breaks this low, or it's simply when it breaks the last low that made the last high. We find our POI or order block or imbalance in the way down, and we can enter on that POI. Or what I like more than these two is a shift plus a liquidity point. Market shifts to the downside, I mean it breaks the structure here, it gives us some point of liquidity, it comes grab that liquidity and reacts to an imbalance or order block. Any kind of shift is good for this concept. We have this plus this shift in the Frankfurt session, and that's so powerful. You can see that it came up, it accumulated some orders, it manipulated it, it shifts to the downside here. So when we can enter the market, we can enter the market on this imbalance because it is an imbalance and it is important, or we can enter the market like this pattern that I talked about. We have our liquidity pool here, point here, our liquidity point here, it came up and it grabbed it and went to the downside. So after the Asian session, we look for trading opportunities. It sometimes happens in Frankfurt session, and it sometimes happens in the London session. You can see the results here, and our stop loss is here. It is 6-to-1 reward to risk ratio so far. So let's see other days, the previous days. Let's talk about this. This Asian session acts as manipulation session because the New York session was ranging. The later times of New York session was ranging. It grabbed it and it went to the downside. And we can see that the London acts as distribution session and the New York as well. So sometimes these roles can be different and change based on the context and the conditions of the market. We have Asian sessions here. The Asian session is trending. You can see that the Asian started here and it went up for 211 pips, but it is an index, so if we count that as pips. Anyway, and when we see the London session, I said that when the accumulation and distribution happens before, we can say that in the next sessions the session is going to come down, liquidate something and distribute in the direction of that setup. And we can see that an order block in the middle of the Frankfurt session is our liquidity point. The London liquidated it and went to the upside, but we want to talk about just the liquidation of Asian session. And after that, when something doesn't happen, it just doesn't happen. So it's like we put our money in the bank. It's not that you say, oh, I was wrong. No, we weren't wrong. For example, here it just didn't come down and grab this liquidity, because the first rule was that we should have a POI and we don't have a POI here above this point, and I said that it should be in the direction of the trend, and it is a reversal. So this Asian session is not based on our setup. We can see that we have something here. We have an Asian session, but this Asian session is trending. So what I said about the trending Asian session, I said that you can mark some liquidities between this low and this high in the middle of the Asian session, and that liquidity acts as liquidity. So this liquidity point is important for us. Why? Because the Asian session is trending. What does a trending Asian session mean? It means that it is going up or it is going down. So when we have something like here or like here in the Asian session, it is better to take trades in that direction after a liquidation of something in the middle of the Asian session. For the liquidity points, you can see the liquidity number 1 and the liquidity number 2 videos. And when the Asian session is something like this, the Asian session isn't trending. So we wait until it come and grab the high or it come and grab the low. After that, we can enter the market. Anyway, we talked about this. So you can see that it came down, it grabbed this liquidity. After the shift, we can enter the market. We don't have a shift yet. Here we have our shift, and here can be our entry point, or if the market provided us with a liquidity point. So here is our entry point in this order block. I don't know, maybe it is a profitable trade, and you can see the results. Let's talk about previous days. After that, in the New York session or London session, it comes and grabs some point of liquidity like this, and we can enter that trade as well. So it came down, it liquidated this low. Let's see if we have a stop loss or no. We can enter the market after the shift. We may have a stop loss here, because if you count this as a shift, you may have a stop loss here, but this shift is better and we can enter the market, or this shift. And you can see the results after that. So where was our, so we have a stop loss on this. We are traders, we have a lot of stop loss. Below these candles we have some kind of a stop loss, Anyway, it is not a stop loss. This second trade is not a stop loss. If you take this trade, you can enter on this lying shadow. We talked about this, and it is a 4-to-1 reward to risk ratio. But here we can have a good entry. When the market shifted to the upside, it broke these structures, and it break this structure as well. Something between breaking and not breaking, but it broke this high. This high made this low, so it is a shift, and we can enter the market right here. Let's see what happens, and you can see the results. So it is the New York session. Let's talk about the previous day. It is the Asian session. The Asian session is a ranging session, and what we have above the Asian session, you can see that here, and something here on this opens and close. It didn't went that far. It's I'm sorry. We have two Asian sessions here, and we have an order block here. So we can stick to these rules anyway. You can see that it came down, it shifted here, it broke this structure or the low that made the last high, and we have a big imbalance here. A big imbalance is pure gold, and even we have some points of liquidities here, so we can have our entry above these liquidities and aim for example, these lows. After that, we can even say that it came down, it grabbed the low of Asian session, and we have a big gap here. So that can be another entry again, and we can enter on this gap. I think it may be a stop loss, or it may be a profitable trade. Why I chose this gap? Because it shifted the market, and it is a gap. Gaps are important in any kinds of markets, but our stop loss is a little bit large, and it is a profitable trade. You can close your trades on 4-to-1 reward to risk ratio, or 3-to-1, 5-to-1. These are the good numbers. After this trade on the New York session, we don't care, it is a profitable trade. It provided us with a 5-to-1 reward to risk ratio. It came down, it grabbed the low. Now we want to see some liquidations in the New York session. Let me see what we have here. So we have these 2 points. Khob means so in the Persian market, I'm sorry. Anyway, it came down, it grabbed this liquidity. Sometimes liquidity is open and close, especially when we have a long shadow, because I talked about the long shadows. But anyway, it is an order block as well, and we have our liquidities here, so we can enter here. It didn't liquidate this low as well, but this low was important, so it is a liquidation, and we can enter after shift. That happened here, and that was our trade. And it may come down and it came down. Did it shift? It shifted here. We may have a stop loss here, and here is our shift. We can enter right. Here is going to be good. Why I waited? Because I wanted to see these lows liquidated. You can see that how fractal is my mind. It's just because I used to these concepts, and it didn't hit our stop loss. You can see how powerful these concepts are. So what we do for taking these kinds of trades, we have our Asian session, and we wait until the high of the Asian session or the low of the Asian session gets liquidated in Frankfurt or London session. And what do we wait here? We wait for here. We wait for a shift in 1 minute. So if we are seeing this on 15 minutes, we wait for a 1 minute shift. After that shift, we can enter on any kinds of imbalance. I mean, what is a shift? When it comes down and it breaks this structure. Which structure? The last structure that created the last higher high or the last lower low. So when that gets broken and we have an imbalance here, or we have a kind of liquidity before that, that's better. We can enter on that imbalance for sales. It is for London session. In New York session, when it is going down, we find some points of liquidity. So for example, we have something like this. We wait until it comes up, it grabs this liquidity, it shifts, and we can enter on that shift again. What are our entry setups or shifts? First is going to be our AMD setup. Can enter on imbalance or order block. What is an imbalance? I talked about this hundreds of times in this channel. An imbalance is the space between the first shadow and the third shadow in a 3 candle formation. So this space is going to be imbalance between the first candle and the third candle. Anyway, let's talk about those trading setups. So it shifts here, it breaks the last low that created the last high, and we can enter on an imbalance or order block. One other thing is that we can simply enter on an imbalance after it grabbed this soft liquidity, it broke this structure and it came up to the imbalance. Another one that I'm interested in is going to be when it gives us a liquidity point right before that imbalance. So these are the patterns that we are looking for in 1 minute time frame, lower time frames. It is enough for today. It was about sessions and how we can trade that. You saw how powerful is this concept in forex markets. You can test that on your own markets, but you should be careful that your sessions may be different based on the country you are living in, but these concepts are so powerful and you can make your way to the trading world with these concepts. Your support is much appreciated. We are in a dark time here. We are in an internet blackout. I don't have internet access consistently and I can't trade consistently, so your support, your subscribes, your likes and your shares are much appreciated, and in return I make a wonderful trader from you. First, practice these concepts in a demo account, and if you felt confident with your responsibility, you can do that in live markets. Anyway, for private mentorship, for long-term private mentorship, one-on-one webinars, and a lot of more concepts like this powerful concept, you can PM me on my Telegram account that I'm going to put in the description. Anyway, thank you for your support and watching, and goodbye.